Está hoy en los mercados, dato que analizamos a continuación en clave internacional con Jay Pelosky, fundador de TPY Advisory. Jay, thank you so much for having us a few minutes as always.
Hi Martha, nice to speak with you again.
Jay, inflation data in the US showed us a new decline today, but it didn't beat expectations. How do you see that?
Well, I think it came in, as you say, lower year over year, but a little higher than in the past several months. So, I look at how the markets react, right? The reaction is what we want to see. And you look, bonds are roughly flat, maybe backed off a little bit, dollar a little bit weaker. Stocks were down, certainly at the start of the session, but have now rallied back and are in decent positive territory, up about 0.4%. So I think the point is, Martha, that markets are not really surprised for this kind of data, right? The fixed income market has priced in a Fed that may do a little bit more. Inflation should continue to come down. The year-over-year comparisons are pretty benign. And the last point I would make is that the big increase in this month's data was in shelter, and we know that in real terms, in the real environment, the rents and things of this nature have come down considerably. It's just that there's a lag between when that data gets kind of translated into the shelter indicator that's used to calculate the CPI. So the market, I think, looks at that and knows that that number is not really accurate in terms of what's actually happening on the ground, and so feels like the data is pretty decent all in all. And I think that's what you've seen in terms of the reaction by the various financial assets.
As you say, Jay, the most important is the market's reaction. We've seen, indecision in the markets after the inflation data. What do you think investors are pricing in right now, and what should we expect? Because we are expecting new data in a few days, weeks, the PCE, the inflation data that the Federal Reserve is looking at more significantly. What do you think about it?
Well, our view has been really since mid last year that we're going to be able to kind of make that middle path, as we called it, or middle way between high inflation and deep recession. And the market's been trying to price between those two, whether it's fixed income or equities. And I think increasingly it looks as if we're going to avoid recession in the US, as we are likely to avoid recession in Europe and globally. And so in that environment, I think you've seen the fixed income market over the last couple of weeks price out rate cuts, right? Because the rate cuts that were priced in for the second half of this year implied a recession. So if there's no recession, there's no need to cut rates. And so I think we're getting comfortable with the idea that interest rates are going to stay higher for longer as inflation is down and the economy remains resilient. And so when we think about things, we're really focused on what we believe is the beginning of a new global growth cycle. And it's being led by the economies in Asia, particularly China, and also Japan. Your prior guest was talking about growth outside of the US and Europe, and we agree with that and are focused on this new global growth cycle that is going to be supported by rate cuts. We think we're at the beginning of a rate cutting cycle. So a lot of this is the headwinds of 2022, inflation spiking, aggressive central bank reaction, spiking interest rates, strong dollar. All those things are now reversing and turning into tailwinds for 2023.
Do you think Powell made a mistake when he talked about disinflationary process in the last monetary policy meeting?
No, I don't. I think that's what we're going to see. The economy is much more difficult. It's not a traditional recession recovery. COVID upended everything, and I think we're still coming out of that. And so we really focus on where are the big imbalances, right? There's no imbalance in the consumer. The consumer's fine, record low unemployment. No imbalances on the corporate side. Corporates are fine, flush with cash, raised a ton of money over the last year. Stock buybacks are at a record. There's tons of money, plenty of cash on the corporate balance sheet. And then banks are fine, right? Banks are making plenty of money, finally out of negative interest rates. Net interest margins are up considerably. So there's no big disconnect or big imbalance in the economy that creates a dynamic where we're going to have a big problem. So I think we are in process of kind of continuing to squeeze out some of the inflationary pressures that existed because of all the upheaval with COVID and with the conflict in Europe and what that meant for energy last year. So we're close to the end of that. And as we move out of this period of upheaval, right, these kind of atypical, ahistorical events, then we return to some form of stability. And we think increasingly that's going to manifest over the course of 2023. We think the Fed is likely to go on pause in the next, after the next cycle. We thought maybe it would be after February, but it looks like the Fed is probably going to take out a little insurance and raise rates again in March, which again, I think is going to be fine. When you look at the housing sector, last thing I'd mention is the housing sector in the US, right? Housing is where typically sharply higher interest rates have their big effect. And we have had a pullback in the housing market in the US, but we've already seemingly bottomed with applications picking back up, even though mortgage rates are at about 6.5%, quite high relative to the last couple of years. So that speaks to a lack of supply, a lack of inventory, and it speaks of demand for housing, which has not really ever recovered from the 2008, 2009 housing bust, where you have a decade where we didn't build enough housing. And so you're seeing that manifest. And again, another example of no big imbalances. So the Fed can raise a little bit more and the economy should be okay. And we kind of ride through this process, moving toward a period of gradual stability as we go into the second half of this year.
Jay, thank you so much. A pleasure, as always, for this analysis.
Thank you, Martha. Bye-bye.